Hello, Econ students. Today we are doing notes 5.1, Employment and Taxes. Your essential question, what is the purpose of taxes? So first we're going to be looking at unemployment. So what are the different types of unemployment, how are unemployment rates determined, and what is full unemployment? So we have four different types of unemployment. Frictional unemployment occurs when people change their jobs or they get laid off from their current jobs. This can also happen after you graduate from school and you don't have a job quite yet. So these are the most common types of unemployment, frictional unemployment. We also have structural unemployment, and this is when a worker's skills do not match the jobs that are available. So if we have technological advances that can cause people to no longer need their job is no longer necessary, then that can cause unemployment for people. Seasonal unemployment can happen when there is a seasonal shift in the production schedule, so they no longer need quite as much of that thing. So, like right now, a lot of Christmas tree farms have just opened up, so people who are working there, working in the Christmas tree industry, once December 25th rolls around, that is no longer going to be necessary. So those people will be seasonally unemployed again. And cyclical unemployment, unemployment that rises during economic downturns and falls when the economy improves. So a lot of people who are facing this right now due to COVID, a lot of industries have shut down. So the nation can determine the unemployment rate for the whole country, and this determines the health of the economy. The unemployment rate is the percentage of the nation's labor force that is unemployed. So, an unemployment rate is only the national average. It doesn't reflect any regional economic trends, so some states are doing worse than others, does not use that as part of it. So, it's just an average for the whole country who is unemployed. So, full employment is when the level of employment reached when there's no cyclical unemployment. So the unemployment rate for a healthy economy typically is about 4 to 6%. That's a normal unemployment rate. Sometimes people who are underemployed is when they're working for a job that they're overqualified or they're working part-time when they actually want to work a full-time position. Discouraged workers are also people who want a job but have given up looking for one. So they can often have a lot of discouragement when you're applying for job after job and you're not getting any interviews or you're not getting any jobs. So this is the range of unemployment based on age and based on degree level. So as you can see, the national unemployment rate is highest for teenagers. So people in your age group, 16 to 19 years old, you have the highest unemployment rates at almost about 25% of the people who are actively looking for jobs. Adults, that's a much lower rate, adults ages 25 and up. Right, so inflation. Inflation is a general increase in prices. So, the purchasing power of money is the ability to purchase goods and services, and this is decreased by rising prices. So, the price level is the relative cost of goods and services in the entire economy at any given point in time. So you can think of unemployment, maybe your grandparents, they might have said, like, oh, when I was a kid, you could buy a soda pop for a nickel. I don't know if any of your grandparents actually talk like that, but if they did, that would be an example of inflation. So a general increase in prices. Now a soda would probably cost you $1 or $2, depending on where you're buying it, but definitely not going to get that for a nickel anymore. So the price index is the measurement that shows the average price of the standard group of goods and services over time. So the consumer price index is computed each month, and that determines the standard of goods that are typical of what people will buy in the United States. Changes in the CPI from month to month help economists measure the economy's inflation rate. And again, that inflation rate is the percentage change over time of that price. So if we can look at here, typical like grocery items would be the CPI, the consumer price index. So the prices of vegetables, the prices of meat, the prices of fruits, things like that. There's also calculations for inflation. We are not going to calculate inflation in this class, but that is what economists do to figure out the actual inflation for the nation. So, the causes of inflation. There's a few different theories on why we have inflation. The quantity theory of inflation states that too much money is in the economy and that leads to inflation. So, kind of like in the Great Depression, if we were just printing more and more money, that money is going to be worth less. The cost push theory says that inflation occurs when producers raise prices in order to meet their increased costs. And the demand pull theory states that inflation occurs when the demand for goods and services exceeds the existing supplies. So, what impact does inflation have on the economy? Inflation impacts the purchasing power, so the amount that you can buy with each dollar that you have. So, with higher inflation, the dollar has less value. It can affect interest rates. So, if you're putting your money in a bank and you're trying to save money, you're trying to get a higher interest on that money that you're putting in the bank, you actually can end up having a lower interest rate, so you're not making as much money, or you can end up losing money over time. And then, of course, income. So, if you're still getting the same check, but everything costs a little bit more money, then that's going to hurt you financially. So, poverty. The Census Bureau collects data on families in the United States that are currently living in poverty. So, the poverty threshold is the income level below which an income is insufficient to support a family or a household. So, I'll show you what these rates are. These are average rates for the United States. The poverty rate is the percentage of people in a particular group who live in households below the official poverty line. So this is the poverty index here, the poverty lines for 2020, which is our current year, and 2021, which will be next year. So this is the federal poverty level. So that means it is conducted Washington, D.C. for the whole United States, and this is the average. Now you can see here it says for a family of four, the poverty line is going to be $25,000 this year. So they expect that if you have a family of four, you should be able to take care of them with $25,000. As we know, if we're just looking at a family size of one here, $12,490. In California, it would be very difficult for one person to be able to live off of that. The cheapest rent you can find in West Sacramento is going to cost you at least $1,000 a month. So you're talking about $1,000. All of your money is going to go directly towards rent, which means you don't have any money left over to pay for the rest of your bills, your groceries, your cell phone, those requirements, bus fare or a car, transportation fees. All of those things don't go into account. So it's going to be a struggle for you to pay for yourself financially just based on that poverty line. And they're able to use the poverty line to determine things like minimum wage. These are our poverty rates of all the countries in the world. This is a little dated, but as you can see, the United States has one of the highest rates of poverty in the world. Causes of poverty. So, causes of poverty often lack of education can cause a lot of people to fall into poverty. It's much more difficult to find a job if you don't have at least a high school education. If you do have a high school education, you are able to make more money the higher up you go, getting a college degree, getting some sort of certificate. Location, people who live in inner cities tend to earn less than people who live outside of cities. Shifts in the family structure. So, if families are dealing with things like divorce or death, some sort of loss, then a single parent family has much more difficulty being able to provide just one income for an entire family. Economic shifts. So, things like COVID, which are causing mass economic shifts right now, cause a lot of people to deal with poverty. And then, of course, racial and gender discrimination. Of course, we know discrimination exists in wages and also exist in hiring practices. So, unfortunately, women and people of color in the United States do tend to make less money than white males in this nation. Income distribution in the United States. So we have mass income inequality in the United States. The richest 2.7 million Americans receive as much income after taxes as the poorest 100 million Americans. So the top 1% makes much more than the bottom 99%. So you can see this really started to change at 1980 when we had a restructure of our tax system. Ronald Reagan trickled down economics, so we decided to have tax cuts for the richest populations, which meant their wages increased exponentially. We do have some government policies that combat poverty. So we do have minimum wages. So based on that federal poverty guideline, the minimum wage determines the minimum amount you need to be no longer considered under that poverty level. Welfare reform is temporary assistance for needy families, which gives block grants to states, and states have job training programs. How are these things paid for? Well, we know we have taxes. So taxation is the primary way that the government collects money. Government collects money through taxes, through sales taxes, through income taxes. They collect that money and then they redistribute it throughout the United States. The Constitution, of course, as we learned about in government, gave us the power to tax. So Article 1, Section 8 of the Constitution, Article 1, which established that legislative branch, grants Congress the power to tax. And then the 16th Amendment gives the Congress the power to levy an income tax, meaning a tax on the money that you're making from your job. There are different tax structures that exist in order to collect taxes. So proportional taxes are taxes that a percent of your income is paid in taxes will remain the same for all different income levels. And then there's progressive and regressive taxes. Progressive taxes, the percent of the income paid increases as the income increases. And then regressive taxes, the percentage of income paid in taxes decreases as the income increases. So the characteristics of a good tax. A tax needs to be simple. Taxes have to be easily understood so people understand how to pay their taxes, how all of it works. They have to have government administrators being able to collect taxes in the economy. They have to be certain. People need to know when their taxes are due, how much is due, and how they should pay them. So, how to go about paying their taxes. And then tax systems should be equitable. They should be fair. No people in the United States should be paying more necessarily than anyone else. It should be proportional based on your income. So if demand is elastic, a tax will increase the price of a good and consumers will bear a larger burden of the tax. But if demand is elastic, then the opposite is true. So we're trying to make it equitable in the United States in our tax system. So federal taxes. So individual income taxes, so the income taxes that you all have to pay once you get a job. We have what we call pay as you earn taxation. So they collect your taxes throughout your year. Every individual paycheck that you get, probably twice a month, you will be paying taxes on. They withhold taxes. Employers take a tax payment out before employees pay before you receive it. So when you look at your pay stub, you will see you had a starting amount before taxes, and then they took out your taxes, and then you have an ending amount after that at the bottom of your pay stub. Tax brackets are the federal income tax progressive tax. So in the United States, we have 6 different rates, and these are based on how much income you are making. And so this is the way that our tax system is broken up. So if you make between $0 and $14,000, which if you're working a minimum job, that's probably how much you're going to be making, you will be paying 10% of your income to taxes. And then every dollar you make after $14,100, so $14,101, that next dollar, all the way up to $53,000, you will be paying your 10% of taxes, which is that $1,410, plus 12% of any amount over that $14,100, excuse me. So that's the way our tax system works. Everyone pays the exact same amount, the exact same percentage. It just increases for any of the next steps. Okay, so the next steps up. So our highest tax percentage is 37%, and that is for any amount over $154,793. So to pay your taxes, you have to file a tax return. We're going to learn how to file our taxes in our next unit, Unit 6, when we're learning about personal finance. A tax return is a form on which you declare your income to the government and you determine how much you owe in taxes. Your taxable income is the total or your gross income minus your exemptions and minus your deductions. Employers are required to send you a form. It's called a W-2, and they will send that to you in January. They have to send it by January 31st. So you'll get it probably end of January, early February if you had a job this year. Single dependents under 65, that is all of you. You need to file your taxes if you earned more than $6,300. If you didn't earn more than $6,300 this year, you technically do not have to file your taxes. You might want to do it anyway, just because you probably overpaid on your taxes and you probably will end up getting at least a couple $100s in a tax return. Taxes are due annually by April 15th, so you have to file your taxes by April 15th. This year it got extended until the summer because of COVID, but normally April 15th. Exemptions are the amount that you subtract from your gross total income for you and if you had a spouse or dependents. And deductions are the amounts that you subtract from your gross income. So for example, some people in their jobs, they have deductions that they can remove from their taxes. So like teachers, we get to remove $250 from our taxes for teacher supplies. So like whiteboard markers, posters for our classrooms, things like that that we buy for our students, we get to deduct $250 on our taxes. Corporations also have to pay a federal tax. Corporation income taxes are progressive taxes. There are also other taxes you'll see on your pay stub. So you'll see something called FICA on your pay stub. That's the Federal Insurance Contributions Act, which is your Social Security. You will probably all be paying into Social Security. Most jobs pay into Social Security, so then you can collect Social Security once you turn 65 as well. You also have to pay Medicare and unemployment taxes. So you pay Medicare so that people who are low income or people who are over 65 can have medical insurance, and that you also can get once you turn 65. And then we have unemployment taxes as well. So you actually pay into the unemployment rate. So you pay unemployment every single time you have a pay stub. And that way, if you ever lose your job and you need to collect unemployment, you can also collect money out of there. There are other taxes as well. We have excise taxes, which are sales taxes. All of you have paid these before. Estate taxes are taxes on the total value of the property of a person who has died or the money of a person who has died. So if someone dies and they are a millionaire and they're passing on things to their family members, they do have to pay estate taxes. There's also gift taxes and import taxes. So imported goods, they're called tariffs. What do we use all this tax money on? This is federal spending. So federal spending is what we spend our tax dollars on. Mandatory spending is the money that lawmakers are required by law to spend on certain programs and to spend on the national debt. And then discretionary spending is what they can make choices about, what they can choose to put more or less money into. So this is just sort of breakdowns of what we spend our money on. Remember, the president in their State of the Union address that they give every January, February, the beginning of the year, when they give that address, they tell Congress what they believe that Congress should be spending money on, and then Congress comes up with a budget. An entitlement program is a social welfare program that people are entitled to if they meet certain eligibility requirements. So Social Security is the largest government spending entitlement program that we have. So that's once you turn 65, you are able to retire from your job and collect a check from the government that you've paid into all of your life. So you pay into Social Security as soon as you start working, and you continue to pay in as you work, and then you're able to collect this check that you are entitled to once you turn 65. Same with Medicare. Medicare is healthcare. We believe that people are entitled to have healthcare insurance, and then Medicaid as well. Discretionary spending is what the government gets to decide what they want to spend our money on. So, spending on defense, the military, accounts for about half of all the federal government's discretionary spending. They also spend that money on things like education, what we're doing right now. This is paid for by taxes. Also, things like environmental cleanup, our national parks, roads, police, firefighters, farm subsidies, foreign aid, all of these things are paid for by tax dollars. States also collect taxes, so you also pay taxes to the state of California, and you pay local taxes here in West Sacramento. States also have to go through the same process. States also have a budget. The state legislators write that budget and get to decide how they're going to spend their money. And then, how are state taxes spent? Well, they're spent very much in the same way. So, state taxes are spent on things like education. River City High School, paid for by state taxes. It's also paid for by local taxes. Remember that measure that was just on the ballot in November, Measure Z? Well, that was something to improve our schools right here in West Sacramento. And that's something that's paid for by local tax dollars. State taxes also pay for public safety, so police systems, correctional facilities. They pay for highways, transportation, airports. Our massive airport here in Sacramento, paid for by taxes. State taxes are also spent on public welfare programs, so public hospitals, free school lunch programs, arts and recreation, state parks, museums, our local parks here in West Sacramento, all paid for by taxes. We also have sales tax in the state of California. It's about 8% for our sales tax. And then local governments, of course, right here, Washington Unified School District, that is paid for by local government spending or partially by local government spending. And a lot of schools are paid for by property taxes. So, property taxes are the main source of local revenue, and these are paid by people who own homes or own apartment buildings or own land in the city. All right, and that's the end of your notes for today. So, don't forget to write a summary, a couple sentences about what you learned.